Your savings are falling behind, and it's not your fault. There are massive forces at play that most people don't even realize. I've spent years researching how inflation, the market, and even hidden economic shifts are eroding your savings, and today, I'm breaking down exactly why your money isn't keeping up with the times. Stick around because what I'm about to share could completely change how you approach your savings and financial planning. So, why isn't your savings growing like you think it should? First, let's talk about inflation. You've probably heard of it, but here's the truth most don't want to acknowledge. Inflation is much higher than the official rates say. Over the past couple of decades, inflation has outpaced wage growth, meaning the money in your savings account is actually losing purchasing power every year. That's a big reason why your savings can't keep up, because it's not just about how much you save, but about how much your money can buy. The second problem is the traditional banking system. If you've got money sitting in a standard savings account, you're losing. Interest rates are so low that your savings are barely growing, if they're growing at all. Meanwhile, inflation is pushing prices up at a rate that makes your savings seem worthless. I've worked with financial experts who are seeing this exact trend firsthand. Even in years with low inflation, savings accounts are failing to outpace it. This means you're effectively stuck, watching your money lose value as time goes on. But there's another big issue, and it's a hidden one: the stock market and its unpredictable nature. The market can seem like a great way to grow your wealth, but what most people don't realize is that the market is volatile, and it's increasingly difficult for the average person to predict trends or make consistent returns. I've done research on why so many people struggle with this. It's because we're told to buy and hold, but that strategy just doesn't work for everyone. With so much uncertainty in the global market, your savings are constantly at risk, and that risk doesn't seem to be worth the reward most of the time. Now let's talk about something a little more personal: retirement savings. The traditional 401k and IRA plans, while marketed as the ultimate way to build wealth for retirement, are also underperforming for many. With the stock market so unpredictable, even with consistent contributions, those retirement accounts aren't keeping up with inflation and other economic factors. Many people I've worked with have found themselves years into retirement, realizing they don't have enough to live as they once thought they would. And here's the kicker: by the time they realize, it's too late to catch up. Before you think about closing that tab and assuming it's too late to do anything, hold on. The real solution isn't to sit back and hope the economy changes or the market recovers. I've personally studied alternatives to traditional savings methods, and there's one strategy that could drastically change how your wealth grows. But you have to act before it's too late. So, what can you do to protect your savings and keep them from falling behind? One option is diversifying into assets that don't lose value over time. Gold, for example, has been a hedge against inflation for centuries. It's a stable, tangible asset that can protect your wealth from the volatility of the stock market and inflationary pressures. I've seen firsthand how this can be a game changer for people trying to preserve and grow their wealth in today's uncertain financial landscape. If you're serious about keeping your savings from falling behind, start thinking about diversification and alternatives that shield your wealth from the dangers of inflation and market crashes. Your savings are too important to just sit idly by while they lose value. If you found value in today's video, be sure to hit that subscribe button. Supporting content like this is how we can get the information you need to take control of your financial future. See you in the next one, in the next.